Hi everyone, welcome to episode 170 of the Art of Business English. It's where we help people like you get the language skills you need for doing business in English. Now today I'm going to be looking at some fun vocabulary. It's vocabulary that you can use in the financial sector. So basically, a lot of things happening at the moment, world's changing, things are going up, things are going down. So I thought, I'd introduce some of this vocabulary that I hear or read about or see in the news every day, and that you'll probably find very useful in your day-to-day English. So let's dive in and look at this week's vocabulary, which is vocabulary for the financial services sector. So the first one on my list is gangbusters. So the meaning of this is to be very successful. Okay, so if something goes gangbusters, it means it's great. It's become popular. So I'll give you an example. The stock price went gangbuster when the company announced they had won a massive public works project. So gangbuster means that the stock price went up like very quickly, and it's successful. It's good. People are happy. Okay, let's look at the next one on my list, which is to pop. Now, to pop means to suddenly explode, and in this case, it's to suddenly explode upwards. So I'll give you an example. The company's stock price popped on Tuesday when their financial results beat analysts' expectations. So you can see here, the pop in this context is positive because, it went up quickly, exploded, meaning like it was really good. Sometimes you might think of something popping and bursting as being bad, but in this case, if your stock price pops, then it's a good thing. Okay, let me look at the next one, and this is not a good thing, to crash. Now, to crash meaning suddenly drop in value or fall. Okay, and an example would be the company's stock price crashed on Monday in after-hours trading when regulators said they were investigating the company over fraud. So here is not good news. If you're being investigated for fraud, obviously not great, and yeah, your stock price is going to crash. It's going to go down. And after hours trading is something where people can still purchase and trade, buy and sell stocks after the close of markets. So let's look at the next one, which is to spike. And this means a sharp increase in something. Okay, so a spike is like, something that you stab into something. So it's got a very sharp point on the end, and that's a spike. So when you see something spike, it goes up quickly, a very sharp increase. So an example of this would be, there has been a spike in sales over the summer, which means that, maybe sales like this and then suddenly, boom. Okay, so a spike in something can be good unless it's a spike in something negative. Maybe there's a spike in complaints or a spike in inflation. So depends on what type of spike, but it's generally applied to the movement that this thing we're discussing makes. Let's look at the next one on my list, which is to collapse. Now, to collapse is to suddenly fall down. Okay, so that's not generally a good thing. So let me give you an example. The collapse in the price of gold left many investors out of pocket. Now, if you're left out of pocket, it means that you have lost the money. The money is not in your pocket. It's out of your pocket. It's gone. So the collapse in the price of gold has left many investors out of pocket, meaning they've lost their money. They invested in gold when it was high, and now the price has dropped quickly and sharply. Okay. Now, the next one is very common now. I'm hearing this a lot recently, and it is to run hot. Okay. And this means that you've got a very active economy. People are buying, selling, and it's lots of economic activity. So I'll give you an example. The economy is running hot in the third quarter and will probably lead to inflation. So lead to means to cause or result in. So if the economy is hot, it means that people are buying and selling and prices are increasing, and the fact that prices are increasing because there's higher demand means that there's probably a likelihood of more inflation. So things are running hot. So if you want things to cool down, the opposite would be to cool things down, then you might have to do some monetary policy like increasing interest rates to stop this inflation. Okay, let's look at the next one on my list, and that is to leave money on the table. Now, if you leave money on the table, it means you're missing an opportunity to make money. No one likes that. Everyone likes to make some money. So let's have a look at an example. If we don't upsell to our existing clients, then we are leaving money on the table. Now, to upsell is, someone buys something that costs, I don't know, $10, and then at checkout you say, hey, why don't you just buy this? It's only $2. So you're upselling, or they buy a package, it's $1,000, and you say, if you invest another 200 euros or dollars, you'll get another whole complete thing. So you're just, you're trying to upsell them. You're trying to sell them one more. They're already committed to buying, so you're trying to give them one more thing. So to leave money on the table is, you're not taking advantage of these people. So if you're not upselling to them, then you're potentially missing out on making money. Okay, so let's look at the next one, and this is very popular now too. It's called Fintech. Fintech, and it's spelled Fintech. And Fintech is actually a shortened version of the words financial technology. And this is a business or businesses who offer financial services using technology. Okay, they're becoming very popular and very fashionable now. So let me give you an example. Fintech is all the rage lately. These companies will revolutionize the financial services sector. So all the rage, if something is all the rage, it means it's very popular. Everyone's talking about it. Okay, so these financial technology companies are going to revolutionize the financial services sector, because probably using technology, they're going to create new financial products or instruments, and then this will help generate new business ideas and new things and blah, blah, blah. Okay, so look out for those fintech companies if you're an investor, because they've got lots of growth potential. All right, the next one on my list is to lap something up. So if you lap something up, it means, yep, with your tongue. It's like a dog when it drinks. So if you lap something up, it's to respond enthusiastically. So for example, our customers are lapping up our latest offer, which means your customers are buying your latest offer a lot. They're really excited about it. They love it. They're very responsive. And it's great if people are lapping up your offer. Okay. Another one, and this one's great too, risk tolerance. Risk tolerance. And this means how much risk an investor is willing to accept on an investment. And here's the example, and this is a general rule. The older you get, the lower your risk tolerance. Okay, so you will not tolerate risk when you get older. Maybe when you're younger, you have a higher risk tolerance. I mean, you will accept a lot of risk on your investments because it's okay to lose money when you're young because you have more time to recover. Whereas when you're older, maybe you don't want to lose your savings because that's what you need to retire on. So risk tolerance is how much risk you're willing to accept on investments. All right, next one is also interesting, and this is related to risk as well. It's called to leverage or leverage. And it means basically using borrowed money to make investments. And the idea is very simple, no? Like you borrow, I don't know, I'm going to borrow $100,000 from the bank and the interest rate is just 2%, but I think with that investment I can make 15%. So it's easy to see that you can make more money with the money that you've borrowed than it's going to cost you to borrow the money. So then you're winning in the end and you can pay down that loan. Here's an example. Leveraging your investment portfolio can lead to greater profits, but also carries greater risk. And that's true. You know, if you have money, if you're leveraged or if you're highly leveraged, it means that if the markets go bad and you can't make profit on that money you've borrowed, then you're going to be in negative. And a lot of banks or institutions that lend you the money, if they see that your investments are going bad, they'll want the money back and they'll make you pay it back at the worst possible time. It's called a margin call. That's another episode. We'll talk about margin calls another day because no one likes a margin call. All right, the next one on my list is venture capitalists. Okay, venture capitalists. And these are basically a private investor or private investors who invest in early stage companies with high growth potential. Okay, so maybe they're like venture capitalists or angel investors. So let me give you an example. Many startups look to venture capitalists for funding when they are just starting out. So yeah, many startups are like, hey, can I get some money from you guys because I need some money to start this project? And if a venture capitalist likes the idea, they will invest in this company because they expect to 10x, which means multiply their investment by 10 or 100x their money, which is lovely if it can be done. Okay, so the last one on my list is boom to bust, or boom and bust, and it means a period of great prosperity followed by a sudden decline in the economy. And that's very typical. So give me an example. My company's fortunes went from boom to bust. So if you go from boom to bust, your company was going really well and then it bust. It went bankrupt and you lost your company and all of your money. Ew. So remember, boom and bust is a typical cycle, especially with this capitalist system we live in. And people think that you can make lots of money when it's booming, but you actually make the money when it's busted. That's when all the opportunities arise. So remember that for the future. Next time the economy has busted, that's the time to invest. Okay, and that's not investment advice. That's just my personal opinion. I am not a professional. Okay, let's wrap things up then. So there you have my list of financial terms to get you sounding like a native. And this is going to be like the first episode in the series of financial vocabulary. So I'll be posting that. So make sure you stay posted or stay tuned and for future updates. And of course, if you haven't subscribed to the Art of Business English yet, then you can do that over at the website. Check us out. You'll get a weekly email with all the latest episodes and information from us, all the free episodes that we keep releasing every single week. And of course, before I go, a couple of things that you can do to improve your business English. We've got a free sample course for the Business Idioms course, which we've put together. So enroll in the free sample course. And if you like, there is a great offer to grab the Business Idioms course at a discount. And I've also got my fantastic ebook, which is 500 Business English collocations for everyday use. There's a lot of vocabulary there. And it also comes with all of the pronunciation for the words as a separate MP3 file. So you not only get an extensive range of vocabulary, but you also get all the correct pronunciation so that you can sound like a native. So that's it for me, people. I hope you've enjoyed this week's episode of the Art of Business English, and I look forward to having you all next week. So you guys take care. Bye for now.